Good afternoon, everybody, and thank you for joining us on this Wednesday afternoon. I think probably we're all fairly tired of living in what's a crisis situation. And I remember right at the start, I had a brilliant conversation with a good friend of mine who also happened to be a commandant of the Royal Marines and commanded masses of forces in Basra and all sorts of crisis situations. And I said to him, what are the learnings you've got from that? How do you deal with it? And he said, well, it's very simple. He said, you have to stabilize, then you have to assess the situation, and then you have to plan. And so most of you have done an awful lot of work over the last really year now in stabilising the situation so that you can just operate in a way that means that you can sustain. And today is all about, right, let's just take stock. Let's assess the situation that we find ourselves in. And let's then look at how we can actually plan for an unpredictable future. And I think the critical thing that we'll explore today is that humans are not good at predicting the future. However, if we can envision a future, then we put ourselves into a great position where we can start to make plans for a future that we can envision. And so that's the opportunity we'll be taking through today. I'm delighted that we're going to be taking questions at the end. If you can put those in through the chat as we go, and then I will be trying to keep an eye on them and organise them so we can group it when we get into the session at the end. And also we are recording the call, and so if you can just be mindful of that in terms of tone and language, that would be beautiful. You may be frustrated this afternoon, but if you're joyful, you can put joyful comments clearly through the chat. In terms of our panelists today, I'm delighted that we've got some really great insights. So we're going to have Theo from Responsible Finance and Robert Kelly from ABCL, who are going to kick us off, giving them some really good insights in terms of their overall perspective on the current landscape. Then we're going to take a deeper dive into the research. We've done some deep survey, which Pulvik from the University of Salford and Neil Alexander from Carnegie are going to take us through to actually draw out, right, what's really happening. And I think hopefully it'll be really helpful for you to be able to look at a situation and say, well, am I an outlier, or am I actually in the place where actually this is the same boat for everybody? And I think that normalizing of a situation can be incredibly helpful. Then, having done that assessment, we're going to go into the and so what? How do we actually really start to use those insights to plan and make wise choices for the future? And Tom Lake and Adam Jackson are going to be taking us through the in-depth guide that we're launching today that many of you have helped us really develop and refine. And then really into, well, okay, that's all very well, but how do we use it? And I'm delighted that we've got Faisal Rahman from Fair Finance and James Perry from Bristol Credit Union to really share some of their practical insights in how you use these tools in a really effective way to make wise decisions at your board level. So that's our plan for this afternoon. We will stick very closely to time and be drawing things to a close by 3:15, and very much look forward to hearing all of the insights and importantly hearing from you, because I think everybody who's taken the time to join us, you will have valuable insights into the situation. So please do take time to share those in the chat as we're going through, and collectively I think that we will ensure that the community finance sector will actually find a way to navigate our way through this uncertainty to ensure we're all creating a future that we really want to be part of. So I think that's enough from me. Theo, I'm going to hand over to you.
Thank you. Hello everyone. I hope you're all staying well. And thank you to Fair4All Finance for hosting this really timely event today. I wanted to offer 5 reflections from the responsible finance perspective on the report Fair4All released, as well as generally navigating the uncertainty that we're in. So first, it has been quite a ride. A lot of our customers have been hit quite hard. You would have thought before the pandemic that being a hairdresser in a bustling city center was a stable job. But as we've seen, people from across sectors have been impacted. And where are they going now? Where are they going to go in 6 months? So second, that reinforces the absolute necessity of the sector. The combination of always being able to talk to a person, who's going to treat you with respect, and having an organizational purpose that's totally aligned with getting good customer outcomes. That's a really unique thing to be doing in the financial services space. If financial capability is like our skeleton, then some breaks and sprains can really set us back. Community finance, I think, is like a physiotherapist. They'll work with you to get stronger, they'll work with you for longer, and in the end, you are going to be stronger as a result. And that's why community finance is key to the recovery. Third, despite what a rocky year it has been, the sector has stayed broadly resilient. And so what got you here? I know from talking to our members, it has been that planning, adjusting, having a feedback loop, doing it all over again. And it's also been great leadership. The report released by Fair4All yesterday is a really good way of documenting that and expanding that toolkit to keep you preparing and prepared for the range of possible scenarios that are to come, to know what your customers might need you to do, to know what your extra oxygen tanks might be in the coming months. Because, fourth, there probably will be a lot more uncertainty to come. There is light at the end of the tunnel with the progress on vaccines, and people are starting to talk about a recovery again. And some people are talking about a K-shaped recovery, and some people are talking about some sort of two-tiered recovery. But what if the recovery feels and looks more like an octopus-shaped recovery, with some people and sectors recovering up, some staying in the middle and the same, some recovering downwards, getting swept to one side by a Brexit current, getting swept to another side by a climate change wave? Knowing that, and in particular in light of the FCA's announcement on regulating buy now, pay later products, we know that more people than ever are going to need the really unique blend of finance support and resilience building that only the community finance sector can offer. And then finally, the report mentions something which is key to resilience, but I think it's also really key to being able to rebound faster when things do start opening up, and that's collaboration. Thinking about the economies of scale that we can get through sharing back office functions, the ability to have a much stronger brand through collective marketing. There's just so much untapped potential here for the sector. And that's where responsible finance is focusing a lot of our work as well. So for example, we're working on partnerships to expand the sector's product range. We're raising awareness on the sector's collective impact to permanently reroute customers away from high-cost credit. And finally, we're working with members to understand what their customers might need during the UK's transition to a lower carbon economy. So those are just some quick thoughts from me. Again, we think this is a really great and timely addition to the sector's toolkit and would encourage everyone to integrate this into your thinking and planning. So thank you, and I look forward to the rest of the discussion today. I'll now hand over to Robert from ABCO.
Thank you, Theo. Thank you, everyone. Robert Kelly from the Association of British Credit Unions, delighted to be here today. Thank you to Fair4All for the opportunity and for the report that's been launched. There's going to be some real consensus in terms of the points that myself and Theo's just made, and I'm going to pick up on that. That certainly wasn't a design plan. It's more by default, but I think that actually echoes the collaboration and the partnership work that we've been involved in, and some of those shared thoughts in the last number of months in this pandemic, and how we try and take our ethical finance sector through these uncharted waters. So for me, the report underpins a number of different items that I think are so critical in terms of long-term sustainability, and I'm going to reference ABCO last year in our AGM and conference in 2020 in March, just before the world changed, really. We launched our town hall consultation findings. It was culminating in a Vision 2025 strategy document that says there's a challenge to our members and hopefully to the wider sector that says, what do we need to look like in 5 years' time? What opportunities are available? How do we how do we drive that innovation agenda forward? And there was 4 key pillars to that, and I think I'm going to reference that today, alongside a wider financial resilience piece that comes out really strongly in the report from Fair4All Finance. So those 4 key themes are sustainability, relevance, purpose and collaboration. So very similar to some of the comments that Theo's just made. From a sustainability point of view, there are clear issues that are in play in terms of the findings of the report. The fall in demand for lending, the off the cliff scenario, and if you would remember that, yeah, we have seen a recovery phase. We've seen the demand for lending in lots of different areas grow again in recent months. But the reality of where we are now is where we probably were in advance of the COVID pandemic coming into our lives, which was that within our sector we have really, really strong, well-performing credit unions with some great and fantastic innovation. The commitment to financial resilience and building financial empowerment within communities is clear day after day after day. But for some credit unions, some of those margins are really tight. And so we recognise that actually what's been done is that the COVID-19 impact has actually exacerbated some of those situations. And that comes out clearly in terms of the report around, you know, those fall in demands, and actually now that we'll see the fall in interest income from lending, the impending issues that we're going to see, I think, in terms of debt problems and credit control and arrears when furlough ends, and all of those different, you know, where we've actually got a stick and plaster scenario at the moment, but how long will that last? And we recognise the challenges, a wider economic perspective for the government. But I think that because we're now in effectively lockdown 3, the reality is I think the support measures that were introduced last year to support community finance and credit unions, CDFIs, had a real positive impact in lots of cases. But we do need to consider whether there needs to be further intervention. And I think that's a conversation that needs to be had. So from a sustainability point of view, the question's still on the table. And how do we achieve that? How do we make sure that there's a strong, robust credit union sector going forward? The other themes that I wanted to cover, relevance and purpose, those are areas that came out loud and clear. How do we get in front of a wider group of people within communities across the country to make them realise that community finance is a much stronger proposition than some of the choices they've currently been using or have been using in the past? And that's very obvious from the impact of the Willard review and the FCA announcements in the last couple of days to talk about the impact of buy now, pay later. And what does that mean for consumers? And I was really struck by a younger demographic for the first time maybe using credit in their lives, and that's the route that they're taking. And are those decisions being taken going to actually influence longer term choices? And are we embedding the wrong types of behaviours so early on in someone's life cycle around financial services and credit in particular? So we need to challenge ourselves to make sure that we remain relevant, we remain true to our core purpose, which is to build financial resilience in communities up and down the country, to work with employers and other stakeholders to make sure that that happens. The other theme in our Vision 2025 is collaboration. And that's a really strong component part of, Theo's touched on it, and I'm sure it'll be an element of the rest of today's session. How do we challenge ourselves to work more closely together? And that might be on technical areas, that might be on technology, that might be in IT, but I think there's a really strong challenge around how do we focus collaboration on other items like culture, like change, like transformation, like making sure that we can learn what expertise is out there. How can we share the stories, the case studies, the great ideas that are out there? How will that build a better journey for so many within the sector that we all cherish so much? And then a wider financial resilience. We know that tough times remain. We know that there will be a demand for credit. I think there's a call to action in terms of understanding impacts on affordability assessments, and we've been talking about that really clearly within the stakeholder groups that we're involved in and with Fair4All Finance. And I think we need to continue to challenge some of those thoughts. And I know that we'll be working closely with the conduct regulator to get a grip on what does that mean and how has that been impacted by COVID. And the last couple of things I just wanted to say, I think as a call to action, we as ABCO are really keen to support our members in developing and implementing some of the tools and the great ideas that have come out in the report. The scenario planning, and I was struck by a couple of comments. How do we operate with foresight rather than with hindsight? And I think that's such a strong component part of the message that the report's giving. So we're committed to working in conjunction with the partners that are on the call today to try and drive that agenda forward, to implement some of those solutions at our level within our membership. I think there's a particular focus on a smaller credit union range, and I think we need to try, and smaller institutions who maybe don't have the resources and all of the expertise, and we need to challenge ourselves to make sure that we can actually drive some change at that level and help them develop the thinking around this. So yeah, scenario plan is fantastic ideas, but I think out of our 170 odd members, only one has ever came forward and said they had a health pandemic on their risk register, and that I think tells its own story. And you know, congratulations to Clockwise Credit Union for having the foresight. You know, I wish they'd shared that with us. As we enter 2020. So listen, thank you for today, for the opportunity to come along. Thank you for the insights that the report has given. We're committed to delivering this and hopefully building on how we implement some of these practical strategies, and we look forward to continuing the partnership and lending our support to drive this sector forward. And I'll pass back to Sasha. Thank you, everyone.
Brilliant. Robert, Theo, thank you very much. It's given us a great overview in terms of perspective, and I think also fantastic commitment from you as trade bodies in really wanting to work with us to help community to use these tools. But let's now just take a deeper dive. You know, this is the second survey that we've done of community finance providers, and Dr. Paul Vick and Neil Alexander are going to take us through a bit more in terms of the data, and then also, you know, a bit of reflection in terms of, and so what does that mean? And I think I'd really recommend this in terms of discussions you're having with your boards. I think it's a great material to actually share, to orient them to, you know, what's happening across the sector, not just in terms of your own situation. So Paul, over to you.
Actually, I think it's me, Sasha. It's Neil. I'm going to introduce Paul in a second, everybody. Hello, hope everybody is well. I'm Neil Alexander. I'm an associate with the Carnegie UK Trust, and from there seconded to also work with Fair4All Finance on their due diligence work. I want to say thank you to everybody who helped us to providing information for us for the survey of community finance providers that my colleague Paul will from the University of Salford will talk you through the headlines of in just a minute. So thanks to everyone who provided information. We know it's not easy to provide that information. Firstly, you're all very busy people, and we asked you originally in May, and then we asked you again at possibly the worst month of the year in November, and then in December to share some numbers with us, and then we wanted to speak to you about it. So thanks to all of you who took part. It's also not easy because what some of the numbers say, and sharing some of that is difficult. So we are grateful to you for entrusting us with your information. So Paul, Paul is hopefully going to put the slides forward. There we go. So we're, as everybody knows, as we don't really need repeating too much, we remain in a period of great uncertainty caused by the pandemic, continued furlough, continued payment breaks, rising universal credit claims, all of that, and no sense of when consumption might return. No sense when we might be able to book a holiday or pay for a wedding or any of those things. Bank of England figures for credit card and consumer credit borrowing in 2020 showed a billions of pound repayment on those sort of debts. But we know that masks pockets where people are actually needing to borrow more. Illustrated very well just the other week, just a couple of weeks ago, by the Resolution Foundation's report, Pandemic Pressures, which talked about how families on low incomes are spending more during COVID. Next slide, Paul, please. So the last time we undertook this survey, we reported headline figures of a drop of 70% in loan values and a 14% rise in credit union savings. Some of these numbers have been reinforced by the Bank of England release on credit union Q3 numbers, and you know, Paul, as I say, will pick up what the headlines are this time around in a moment. Just to say, we had 44 credit unions and CDFIs take part in this survey this time around. 36 took part in both surveys. So we are able to do more with some of that data, and we will produce more data sets around this in the coming weeks. Next slide, please, Paul. Between the credit unions, they represent about half of all lending from credit unions in Scotland, England and Wales, and all of the principal CDFIs in Great Britain also took part in both surveys. Again, grateful to you all for sharing your data with us. The figures range quite a lot between credit unions. They range, there's a lot of deviation in the reporting. Even within months, there's huge deviation in some of the numbers that have been reported to us. So the average, of course, might not be your experience, for better or worse. But enough of that. Paul will now talk you through the headlines from the survey. Thank you.
Thanks, Neil. So, excuse me. So this first chart shows the year-on-year percentage growth in the total number of loan applications received, number of loans issued, value of loans issued, and loan interest and fee income. And the most striking thing about the chart is sort of the yellow line for the value of loans, which were the sort of the worst aspect affected relatively. So value of loans is in 2020 was significantly down year on year, although by September to October we're seeing at least some approximation of what it was in 2019. So in total, between the lockdown in April, end of March, April through to October, lending was down 31%, or nearly 50 million compared to the previous year. Many of the providers that we surveyed say that they have seen a higher arrears, but especially higher forbearance. So 38 providers, around 86%, would say that they've seen an increase in payment holiday requests compared with this time last year, and 24 of those are concerned about this trend. And just over half say that they've seen higher arrears or higher non-performing loans. And in the follow-up interviews we did, a lot of managers said they expected arrears to increase in this calendar year as furlough potentially ends and other support schemes. So for credit unions, one of the things we've seen is an increase in savings. So the table on the top shows compares the loan book and the savings book, so the outstanding loan book, the outstanding savings between from May, when we did the first survey, and then November and December, when most of the organisations responded to the second survey. And you can see the difference is that in this period, the savings book increased by 7.5%, or nearly 50 million, while the loan book fell by just over 12 million, or 3%. So this dual trend puts downward pressure on regulatory ratios for the sector, or for those affected. And 31 of the credit union, 31 of the 38 credit unions that responded said that they've seen an increase in customer savings, and 7 had introduced some form of share deposit restriction to curb this. One of the things that came out strongly in the interviews we did is the whole, which I guess fits really well with this theme is there's a great deal of uncertainty about what the future will bring. One of the credit unions managers interviewed said that it's the uncertainty around the duration and effect of the lockdown and other restrictions. So it's all the unknowns and how many lockdowns there'll be, what the impact they will have, how long they will last, and the difficulty of you don't have it's difficult to benchmark against your previous experience. And there's also uncertainty about what will be the long-term effects on household finances of customers. So there are a lot of government policies and forms of support in place, such as furlough, but also things around restricting landlord and creditor action that will sort of soften the effects of COVID. So the fear is that once those are lifted, what's going to happen in terms of underlying debt and rent arrears issues that might surface. So obviously the impact often the ability to, but especially the ability to cope with COVID will vary quite a lot depending on your organization. So you might be, very well capitalized and mainly just perhaps planning to reduce dividend payments, or you might be somewhere on the pathway towards sustainability and have less capital to draw on. But ultimately, the trends that we see in the survey, and also I think supported to a degree by the Bank of England data, will sort of have negative effect on the bottom line of lenders in the sector. The simultaneous increase in savings and fall in the loan book will result for many in lower capital asset ratios. So one of those we interviewed said that they'd seen 1 to 2 percentage point drops in this ratio following COVID. For those that are seeing increased arrears, there'll be increased costs associated with that, and there are higher costs if you're going to pay a dividend on an increasing savings book. Sorry. And the final point I think is really around this value of lending. So obviously, if you do a much lower, if you do the less you lend out today, the lower that will sort of translate into losses of future income that you might expect from your loan portfolio. I just want to add with one last little plug of the survey. So if you haven't already taken part, perhaps you think that this is sort of not really representative for your experience, then we'd still love to hear from you. And I'm sure they can also put the link to the survey on the chat. So I'll give it over to Tom now.
Paul, thank you, and thanks to Neil too for the hard work that's gone into that survey. I think it's really helpful to have that picture of the whole industry. We know that there are lots of different experiences within that, but it does provide a view of some of the challenges. And we know that despite the positive signs of the growth and lending going back up, that there's some real areas for caution around future income too, and the effects of this lockdown that we just don't know about yet. So it's something that we need to keep a watching eye on. So Adam and I will now give a bit of an overview of the Navigating Uncertainties report, and the thinking that's gone into that, and then also talking about where Fair4All Finance has come out on our own priorities following some similar exercises to the ones in the document. So we'll hand over to Adam first, who's very adeptly led on creating the report over the last couple of months. So if you could kick it off, Adam, given the overview, that would be great.
Thanks, Tom. So I'm Adam Jackson. I've been working with Fair4All and other organisations on scenario planning. I really just wanted to give a brief introduction to the scenario planning guide we published. Particularly, I want to say a few words on why it's helpful for us to imagine different futures and why it's really powerful if you involve all your people in this. But first, as you might see on your screen, I just want to show a video. It's from Saturday Night Live just before Christmas, which is why there's some antlers appearing. And the character is Dr. We Know Dis, and he is discussing COVID. So Temi, take it away. Know Dis. Faced by these uncertainties, organisations can freeze, or they try to predict the future. And generally, when they predict the future, they bet on the wrong strategy. So this time last year, I spoke at a dinner with about 30 business leaders, and I suggested that COVID could lead to kind of the next global economic downturn. I was the only person in the room who thought that was possible. Everyone else thought 2020 was going to be great. My prediction was wrong as well, because I didn't predict the worst recession in history or the devastating impact on lives. So, you know, people can't predict the future. But if I'd said to the dinner guests, imagine your supply chain is disrupted, imagine your customers are closed, imagine consumers are panic buying and your workforce is severely depleted, well, then they would be able to say what they would do to deal with this. And indeed, quite a lot of organisations were resilient in the first few months of COVID because they planned for all of those things. They planned for a no-deal Brexit rather than COVID, but if you like, the effect on them was similar and they were ready. But organisations are bad at predicting the future. They're good at preparing for events, and really scenario planning is about envisioning possible futures and then planning for these. Our guide sets out a step-by-step approach, mapping uncertainties, what will shape your world, developing scenarios, what might the future look like, and then options, your strategy, your plans, and tracking, capturing where we are, where we're heading. I just want to say a bit about those first two stages, mapping uncertainties and developing scenarios. So there's an infinite number of potential plausible futures. You've got to kind of narrow it down to 4 or so to do scenario planning. What we can do is list the uncertainties, if you like, have a list of we don't know this list, and we can work out then which of those most affect us, the most relevant, the most diverse, the most disruptive, and we can paint a picture of what worlds would look like if those key uncertainties acted one extreme or another and in combination. So in the guide we set out some COVID system uncertainties. It's page 13 of the guide. Firstly, in that, and it's probably something we haven't maybe looked at so much in the past in terms of planning, health is the key driver. Secondly, most of the uncertainties aren't new to COVID. It's about the economy, it's about consumer behaviour, it's about government policy. But what is different is how fast those are changing and how extreme those can be. And the same is the case with other providers in the market. We've seen that on buy now, pay later. And we've also in the last day seen how the regulator can move faster in response to those. So thirdly, these uncertainties feed off each other. Health affects the economy, which affects government policy, which affects consumer behaviour, which affects health, which affects the economy. It's kind of lots of little chain reactions all sparking off. So those are intertwined. How we identify the 2 biggest drivers of change for our organisation, for your organisation we're planning, it's kind of to pick out the variables that most fundamentally change everything for you. And I think also focusing on the outcome rather than the cause, the effect rather than the cause, because that's some kind of, if you like, less about predicting the future. Now, I think Robert touched on smaller organisations. Appreciate some of this is harder for a smaller organisation, but I've run scenario planning with a small local arts centre I'm a trustee of. In some ways, it can be easy. For us, the 2 things that affect our ability to help our customers and our community were continued public funding and consumer behaviours. Do more or fewer people come to our arts centre? And we were able to then develop 4 scenarios out of that. Now, my second point is this is an activity that's best done across your team, involving all your people. So don't keep it to yourself or to your board. The more people you involve, the better the scenarios. You've got more perspectives, more ideas. And this is really central to developing the scenarios, envisioning futures. Again, for a small organisation, you can kind of do this. You can do this in half an hour Zoom call or small groups or team meetings. It doesn't have to be massive. I think what Robert's talked about of Abcol really helping people prepare for this could be really invaluable. And then I think it's straightforward to do in your organisation. But bringing the scenarios to life, it's really key to get others involved. This is identifying what will we say in this scenario? What will our customers be saying? How will we feel? What's the newspaper headline? Page 17 of the guide sets out the scenarios we identified. I'm particularly proud of Furlough Nation as the name of one of them. I think I might get t-shirts made with that. And then the quotes are really important. They're kind of bringing it to life of what people might be saying. Now, there's one in Deep Depression where one of the quotes is, "I can't see a way out. I can't see a way out." Now, I wouldn't have come up with that because my personality type is kind of quite rational rather than emotional. But someone else did, one of the team members in the session we had, and that really brings that scenario to life. Now, involving lots of people also means they've all imagined different futures. They can picture them and they can describe these. And critically, that means that when these scenarios start appearing in real life, your people will spot it earlier. What a customer says to them may remind them of one of those imagined futures. So they can provide early warning, they can act. And I think finally, that enables everyone to kind of keep calm and carry on. In 2016, I was working at an accountancy firm. It was the EU referendum. I spent weeks with my team developing two scenarios. What could happen after a yes or a no vote? We built two websites, two sets of guidance for clients. So we were kind of living those two scenarios for several weeks. On the morning of the result, we came into the office. Everyone else seemed to be on another planet. They were upset, they were confused, they were angry. A few people were elated, but people were not calm or focused. My team, on the other hand, had lived and breathed an imaginary Brexit for the previous few weeks. So we knew exactly what we had to do. We were really calm. We knew how to help our customers and help our colleagues. We had not predicted the future. We had explored different futures. We had a plan for these, and we did it as a team. So I'll hand over to Tom now to say a bit more about collaboration on growing community finance.
Thanks, Adam. That's really great to get your insights on that and the sage advice from the example of Brexit too. So the reason that we went about doing this report and this webinar was because we as an organisation experienced a lot of uncertainty last year, as well as we know that many of you did. So we used this scenario planning tool that we've detailed in the report to determine our own strategy. And we know that some of the things that we're working on are kind of quite known to the sector, and some of them are less well known. So what I wanted to do very briefly was talk about a few of the things that we have decided are basically essential out of our scenario planning exercise, and what we definitely know is required. That these are things that we're really clear on and that we want to work with providers on to scale access to affordable credit for customers that we know now more than ever really need it. So as many of you know, we're really focused on scale as an organisation, and there are three areas that we're looking at which we think will really help with getting to at scale provision. The first one is the provision of capital, and we know that the right capital in place is really critical to getting to scale. So we've got two pieces of work going on at the moment to help with that. The first is a scale-up program, which is looking into doing in-depth due diligence into really ambitious affordable credit providers who have high growth plans, and working out how we can support those growth plans to really get to scale. We're also seeking to partner with banks to launch a significant debt fund for the affordable credit sector, to be able to give access to the sector of the debt that we know commercial providers are able to access quite easily in this space and already do. Secondly, to capital, we're focused on capability, and we know that getting the right building blocks in place is essential to resilience, but also getting that provision to scale efficiently. So I'll give a couple of examples there. We're thinking about technology, and we're planning a series of engagements around the use of technology in the affordable credit sector. A few of you might have seen the webinar last week, and we'll be following up on that in terms of great approaches to both technology strategy and delivery. Another example there on capability is the idea of credit union service organisations, which is something that we've heard lots of as an idea coming out of the sector, and we've seen this as a way that we can potentially help to provide a robust way to scale provision efficiently without duplicating work across multiple organisations. So any work in this area we'd really like to hear about. Then lastly, in terms of getting to scale, we're going to work on routes to market as well. And getting access to customers who we know need affordable credit. So we're looking right now at some of the barriers to awareness of affordable credit along with the FCA, and this was mentioned in their Woolard review yesterday, and following that we hope that we can address some of those barriers. Then specifically there are a couple of areas we're looking at in terms of partnership approaches that we think can really help with that access and routes to market. Firstly, we know that housing associations and workplaces are both really important channels for getting credit to customers. And we'll probably publish a report later this quarter, which will aim to make the business case for housing associations to invest resource into turning partnerships with affordable credit organisations into outcomes for customers. Secondly, we're also exploring with banks whether a substantial referral program could take place from branches or online offerings into local community finance providers. And in that respect, we think the pandemic provides a platform to have these conversations with institutions about what customers really need. And again, we're pleased that the FCA review yesterday shared that view. So these are some of the things that we're working on, but how are these informed by thinking about uncertainties? And that there are a couple of themes that run through all of what we're doing. The first one is sustainability. So sustainability is more important than ever given the challenges of the pandemic. And all of our work aims to make the models that loan to customers in vulnerable circumstances more scalable in a sustainable way and therefore more robust. And alongside that sustainability point, some of the conversations that we've been having over the last year have been about consolidation, particularly in the credit union sector. And we have actually seen some really good examples of providers coming together to maintain an amount of provision where it might have otherwise disappeared if that provider was struggling. We expect more of this might actually happen this year, and we know it won't be right for every organisation, but in some places mergers could actually be really critical to maintaining a service for members. And if this is something that you're looking at, we can potentially help to explore that. Then secondly, on why we're doing this stuff in light of COVID, we think to get to that robustness and sustainability, an ecosystem approach is really important to getting there. So we're heavily focused on partnerships throughout our work with banks, debt advice charities, housing associations, employers, other agencies to significantly scale access. And we think that both with us and the trade bodies and across providers, that ecosystem approach is really important. And lastly, I think if the pandemic showed us anything, it's that a laser sharp focus on what customers need is really required. So thinking about those needs that come out of the explosion of buy now, pay later, and what affordable credit can put into place to head off some of those more nefarious forms of lending before they become a bigger problem. So there's a lot that we're thinking about and a lot that we know needs to happen. And we're really conscious that Fair4All Finance has multiple programs going on, and some of what we talk about might be kind of a bit confusing at times, and we don't always give as much detail as we might be able to. But what I hope this webinar does is provide some seeds of thought which could be helpful. We know that so much work is already happening on the ground, and we'd love to hear great examples of this and work with them to get to scale. So please do reach out if you've got work in any of these areas going on already. We also don't want to be a blocker to any of this work happening in earnest and delivering for customers. We won't be a delivery organisation ourselves, and we really want to work with you to turn these programs into real impacts. So please do reach out if you've got work going on in these areas, or if you'd like to explore what we're doing in more detail on a call. So that's very briefly what's in the guide. We hope it's useful and that it provides some insight for what you're thinking about, and perhaps a thinking tool to analyse the current situation. What we're going to move on to now is a couple of examples from community finance providers who have taken scenario planning approaches and use them to adapt to the pandemic last year. So we've got Faisal from Fair Finance and James from Bristol Credit Union, and we're grateful for them taking part in this, and I'll hand over to them now. So Faisal, I think you're up first.
Thank you, Tom, and thank you for inviting me to come and share our experience of how we've navigated the pandemic. So I've prepared a few slides on some of the lessons learned and the process we've taken, and hopefully some of that you will have done a similar version or have iterations of your own. So if I switch over to our slide now. As mentioned, most of us do some type of scenario planning, or at least think of the various risks our businesses plan for in the coming year. I mean, at Fair Finance, we do our budgeting in January, and we looked at all of the risks and we identified the opportunities and challenges ahead of us. I can guarantee you that although we looked at a bunch of downside scenarios, we didn't have a global pandemic, a health pandemic on them, nor did we have anything about understanding the impact of what government lockdowns would cause to our business and beyond. And nobody can really, but what you can do is you can work through some planning for crisis management and work through the issues and try and give that crisis management some structure. So I'm going to share with you some of that crisis management structure we walked through, which helped us navigate that, and some of the things that we learned as we went through that process. In many ways, crisis management comes easy to all of us, but it's definitely it's worth thinking about crisis management in different stages. Often we all know how to deal with the short term and have a sense about the long-term horizon. What I found and what I was most worried about was the medium term, which is really hard to plan for. So some of the concepts that I used to help navigate that are as follows. The first, which is what we all did, we responded to the crisis. We reacted to what was in front of us. So at Fair Finance, we focused on our staff, clients and supporters. We sent everybody home early as it became clear that the lockdown was coming. As we were heading into the lockdown, we started to navigate how we would provide all our services online and remotely, communicated to customers. And then we reached out to all of our funders and stakeholders and supporters to tell them exactly what we were doing, what we knew, and what we were expecting, if we were expecting anything in the coming months. The second was about focusing on resilience. So focusing on the costs and the balance sheets of the organisation. This is really about trying to figure out how we can give ourselves time to start planning the next steps. You've got to get enough work done here so that you can begin to shift your thinking to the longer term strategy. So we looked at costs, we looked at what could be cut if needed, and by when. Obviously, a lot of our costs are staff, and many of the variable costs like technology, the rent, the development things, we started to replan when they could be spent and how they could be spent. But most importantly, we reached out to every single creditor very early to let them know what we were doing, and we started to ask them if there was any help that they could provide. And we spoke to all of our funders. We reached out to every single one saying that we're trying to work our way through and we may need their help in the coming months. Although we weren't asking for anything, it was important that we put a marker out, that people understood that we were working our way through and trying to figure out what to do. Once you can get yourself some time, once you can build some balance sheet strength in the organisation, it's definitely worth thinking about the rebuild, as we called it in Fair Finance. The focus on how you will return to the market, how you will get your organisation back to where it was. Like at many organisations, in those first couple of phases, we saw an absolute cratering of our demand. And we knew that if we couldn't get demand back up again, or at least demand that generated income back up again, then we would be struggling in the final quarters of the year. So we focused on income, thinking about our policies, thinking about the credit structure, thinking about the risk models, looking at how we were writing business, if we were able to write it, but also looking for other income, talking to funders, looking for liquidity, trying to find ways of bridging the oncoming gap. Now, we couldn't quantify how big it was because we didn't know how long it was going to be, but we did focus on it. And then the second was around data. We needed to know whether our customers were radically changing or not, and we didn't really know what was happening to them. We didn't really know how they were going to perform for us, and we didn't really know what was going on. So we wanted to collect as much data as possible from the information that we had. How were they performing their loans? What were they telling to us when they spoke to us? That gave us some sense of how we would get this product back into the market. Probably the next big area of work was around rethinking. I think we realised very early on, probably around July or June, July, that the world was not going to be the same again. So we started to reflect on what the current business model was and what the operating structure and whether it would be fit for the changes occurring in the market around us. You can only do this if you focus on insight. So we started talking to our customers in a much more engaged way, not about their loan, not about whether they would pay it or not, but actually what was going on in their lives. We were really conscious that having closed the branches, we didn't really know what was happening with our customers. We weren't having those soft conversations. So we ran surveys, we worked with an external agency, we did one-to-one interviews, we worked with research partners to really understand the changing behaviours of our clients. We wanted to know a huge amount of information, things that we wouldn't have even asked for. Where were they spending? How were they spending? What were they doing? Who were they talking to? Where were they going? Who were they asking for help from? Just trying to understand what was going on in their lives at that time. And some of the insight of that we published, so it's on a website that you can go to, customerinsight.fairfinance.org.uk. But some of the things that we picked out, which obviously is not new to us now, but at that time it gave us the opportunity to start thinking about what our solutions might be. So we understood that the impact of COVID was unequal on our customers, and we could begin to start stratifying the different customer groupings, how it was impacting them and what their needs were. We learned a lot about the different needs in those groups, what they needed to get help with, those who weren't being impacted in any meaningful way, for whom life was just as tough as it always was, some of those who were actually in a better place where they were saving, and others who were really, really stretched in ways that we hadn't anticipated. But probably the biggest insight we picked out was the close interplay between health and finance, which obviously sounds obvious considering it's a health pandemic. But it was also realising that many of our staff work at the NHS but didn't have NHS contracts. Many of them were making choices about finance in lieu of their health, knowing that they had to work in frontline roles and put themselves at risk. Understanding that was quite important to thinking about the next bits, which is around, what did they need from us, or what did they need from anyone in order to navigate this? We understood a lot more about how they wanted their services delivered. Very few of them wanted to come back to our branches, even if they were opened. But more importantly, probably the biggest insight we picked up was that obviously we could understand how people's financial resilience was being impacted. But what we realised more than that was that in order to rebuild their resilience, we were going to have to work on more than just finance. We were going to have to find different types of partnerships. And that was a big insight for us in terms of rethinking our business, which then led us to reorganising, really focusing on making decisions about the business, about the products that we offer, the people that we work with, the policies that we wanted to implement through the company, the way our service was delivered, and ultimately rewriting our strategy. So at Fair Finance, we realised that most people were coming to us for advice, and they were people who'd never asked for advice before. So we built an online advice tool so that they could navigate the complexities of advice, the government support that they could access, the debt advice they could get to, the welfare benefit support they needed. We used the insights of our customers telling us that they needed to rebuild their credit history to develop partnerships with credit repair companies. We worked with other third parties around employment rights, around debt advice, benefits advice, to start building interconnected service level contracts so that we could start offering these services to our customers. None of these were core. They weren't our lending product. They weren't our banking services, but they were the kind of things that we knew people needed to get immediately. We used that deep dive into the customers to rewrite our credit policy so that we could figure out how we could re-lend again, adapted our scoring model to reflect the diversity in our client base, and we shifted our service model to making a big call, shutting our branches permanently and recognising that we needed to shift a lot more investment into technology and the service design model of the business. In essence, we rewrote our strategy. We were more than just a loans company, and this led to a rethink of how we position and market ourselves. All of which were really important for getting people to understand that we could be helpful for them in the market that was coming to pass. So what did we learn out of that? Well, obviously, you've got to do what you can do. You can't scenario plan things. You can't scenario plan everything. You can't plan for things that are outside your areas of expertise. So you really need to focus on what you do know and can control. You need to understand what the limits of those are. But you also need to engage early with your network to ask questions about the things you don't know so that you can get as much input as possible to figure out how you're going to be able to answer some of those questions. You don't need to answer all of them, but you do need to start thinking about your business and the medium term. And it's often the medium term that's the hardest to start thinking about. And so the most important thing we did at Fair Finance was to figure out how we could get out of firefighting to start making those plans, and then start making some decisions to build a much more flexible operating model and team in order to respond to the future needs. And then finally, nobody's going to be able to tell you how to redesign your model for your customers. It's going to be your customers. So diving deep and working hard to really ask them what's going on in their lives is probably the most important thing you can do to try and figure out where you could go next. Thank you.
Thanks, Faisal, and thank you to the Fair4All team for inviting me to say a few brief words around our own scenario planning that we did in Bristol Credit Union as we moved into the pandemic last year. So I think we, as a slightly smaller organisation perhaps than Fair Finance, we kind of didn't take quite such a structured approach to scenario planning, but we did really get into it in quite a big way as the pandemic approached, particularly because we could see that there was so much that was going to be unknown. One of the things that really brought that home was a presentation quite early on with the Bank of England, where they shared their own thinking around the economic future. And the big message that came through was that they had as little idea of what was going to happen as anybody else did, and that really their own economic modelling was pretty much useless in terms of predicting what was going to happen. And that kind of led me to think, well, if the Bank of England can't predict this, there's no way I'm going to be able to in Bristol Credit Union. So there's no point really even trying. And there's no point to doing what we traditionally would have done, which is said, okay, we've got a change situation. What assumptions in our financial model need to change? What assumptions in our budget and our strategy for the year need to change? And then set about trying to quantify those and figure them out very directly. So instead, we kind of took quite a different approach, which was really trying to just imagine what was going to happen. And very much touching to some of the things Adam was speaking about before, really trying to think about what was going to impact on members' lives, what was going to happen to our borrowers in terms of their situations, and then what we could do about those, and importantly as well, how we might be able to turn some of those into opportunities as well as issues to deal with. So I thought I'd just touch on a couple of the practical things that we were looking at the time. So very early on, we were kind of thinking collectively. We did involve the broader team in doing that. So again, I think that's something that we found really valuable. There's no way that we have a monopoly on insight. Certainly as leaders of the organisation, the broader staff team have such a lot to add because they're oftentimes much more directly connected with our borrowers and with our customers and our members. One of the things that we know from past experience is that our borrowers will miss payments every now and again, particularly at times like Christmas. So very early on, we kind of said, well, what's likely to happen if people are unable to work? Well, they're going to miss payments. And we thought, well, actually, rather than just wait for that to happen and then deal with the consequences, which is then potentially lots of work for us and doesn't do the borrower any favours either, let's get out right ahead of things and invite them to talk to us and ask us for a payment holiday. And we did that a good couple of weeks before the PRA and the FCA suggested that was the responsible course of action for lenders to be taking. And it was very much trying to make sure that what we knew was going to happen anyway was dealt with as positively as it could be, and that we really were able to treat it as a very positive thing for our borrowers, so that they could talk to us and make arrangements to suit them. And rather than trying to put lots of criteria around the ask that members would make of us, we really said, well, whatever you need, you ask for it and we'll be able to help you with that. It didn't feel sensible, bearing in mind the number of unknowns at the time, to try to second guess, you can only do this if these conditions are met, or we'll only do it for a month and then you have to come back and talk to us again. It was very much kind of tell us what you need and let's help you with that. I think the other thing that we really tried to do with that encouragement of people to talk to us was to find out things like what sector they worked in, whether they were needing support because they were actually ill, they were supporting somebody else, they'd been laid off, whatever the circumstances were, to try to give us that insight into their future circumstances and importantly into the potential then for them getting back on track at some point in the future as well. So that was one side. Of course, as many other lenders did, we had a good think about the potential risks of maintaining lending in the same way as we have been doing it. And we did decide to tighten our criteria quite significantly. So we immediately reduced the total, the maximum loan that we would make to any one person. We reduced the level of risk we were prepared to take, particularly where there was uncertainty around affordability and most particularly around employment. So trying to think through, okay, if we're all shut at home, what are the sectors that are going to be most impacted by that? Hospitality being a very obvious one, where we have traditionally had more borrowers from that sector because of the nature of the work compared to areas where people might have more stable employment and therefore might be more suited to or more able to borrow from a high street lender. We tend to know, we know that we're overweight in certain sectors, hospitality being one of those. So I think that, again, was something that we had to do, but then we turned that as well into a positive by saying, okay, well, if we've got spare capacity in the lending team, who we don't want to furlough and who we want to keep working, and we know we're going to have a low level of lending, and we're also going to get very little on our cash in the bank, what can we do to turn that into an opportunity? So that's where we launched the interest-free lending to NHS staff scheme as well, to say, again, let's not try and put lots of conditions around it. Let's not try to earn anything back. Let's just genuinely make use of the capacity we've got and the resources that we've got to bring to bear, and turn what is an issue of not doing many loans into a positive of being able to do something great for people who really need our support, and who we just felt it was the right thing to do to be able to offer something to at that time, which was hopefully even more tangible than a clap on a Thursday evening. I think that there are a couple of other things I would touch on as well. In particular, remote working. We moved to remote working quite quickly. We have kept the branch open throughout for those who really need that particular service, but we moved quite quickly to remote working. But then also thinking through the longer term future, we've also been able to turn that into a positive too. So in future, where we are working with the staff team, they'll be able to use that remote working capability to have more flexibility in their work. So our expectation becomes that people don't need to come to the office 5 days a week full time. It can be much more flexible than that, and therefore we can work to help people to live their lives as well as focus on their work in a much better way than we were able to before. So hopefully that's just a little flavour of the things that we did in Bristol to try to cope with the situation, and also to try to turn those things that we could see were going to be issues into positives through using our imaginations and just trying to work through how people's situations were going to be affected by COVID and the pandemic. And I will now hand over to somebody, and I haven't got any notes here to say who it is. Hopefully somebody can help me to do that.
Yeah, it's great. You'll be handing over to me. Thank you so much, James and Faisal, for brilliant insights and really bringing to life how those tools can be used in a very practical and relevant sense to the size of your organisation. And I think the critical thing here that hopefully you're really picking up is that, you know, if you can have a really good understanding of what is happening in the marketplace, and understanding, you know, the breadth in terms of how the situation is impacting the industry and the wider environment in which you operate, but also can really draw on those in-depth insights that you have to your customers. What is it they need? How do you need to adapt? And engaging all of your organisation in actually sharing what they're seeing, then you can get a much more complete map of the world in your assessment of the situation, and then use your collective imaginations to really think through, so what might this mean? How might this transpire? And therefore, how might we develop? And I think that one of the things I'd really urge people to do from this is that, you know, one of the things that we see, and I think that James brought this out very nicely, which is, you know, you realise that people are going to, with unpredictability in their incomes, that they might not be able to make payments on time. So offering people forbearance and flexibility, how might we take that insight forward into the future development of community finance and the products that are offered? At the moment, isn't it crazy that we have a system whereby you know, effectively people are judged on being able to make predictable, straightforward loan payments, which is all based on people having predictable incomes, when actually the customer group that we're serving, that's not how they operate. How could this sector take a lead in innovating to create products that are really designed for the circumstances in which our customers are in? And I think this is the real opportunity as we start to move forwards. So now I'm delighted to say that we're moving into questions, and thank you. We've got 17 questions so far, and keep them coming. I'm doing my my flight pilot one. So what I was going to do is probably there is sort of, I guess, sort of 3 different groups of questions, some in terms of like our strategy at Fair4All and who we support, some then a bit more, I guess, getting some more in-depth insight in terms of the data, and then some around, well, how do we explore some of these opportunities? So I'll group them into those 3 buckets, if that's okay. But I'll start off because quite a few of the questions are really in terms of the support available for smaller credit unions, and a challenge that we've had quite a bit of. Fair4All, you launched this resilience fund, but you sort of set a certain level. Why did we do that? From a really practical level, it comes back to our organisational purpose, which is all about how do we really increase the financial resilience of people in vulnerable circumstances through increasing that access to fair and affordable financial products and services. Our job is to really look at how can we create a sustainable market at scale to address that need, and at scale is the critical element. So when COVID happened, we were a team of just 6 people, and we were able to negotiate with our board to get an additional £5 million, saying we need to do something to be able to really support the community finance sector through this emergency period. And we needed to make a really sort of strategic choice around, right, how could we focus that in a way that balanced the resources that we had with also making sure what we were doing was actually making a contribution to our longer term strategic aim. So we are currently working with over 32 providers who are covering over 50% of affordable credit provision. However, we're very mindful that we haven't been able to split our resources across the some 400 credit unions operating across the British Isles. So we will be doing something later in the year to be able to really understand the business model of the smaller credit unions, the part they play, and how we might best be able to support them. And we'll be working very closely with ABCL in that. So I know that for those of you who desperately want some support and we haven't been able to support yet, that would probably be a frustrating answer, but I just say, please bear with us. And I'll just say, Robert, I don't know if you want to add anything else on that, because I know that you've been really quite thoughtful in terms of the tools and the support that we're developing, how we can make sure it really works for the smaller credit unions as well. So I'll just hand over to you to see if you just can add a few more comments in that space. That would be wonderful.
Yeah, thank you, Sasha. I mean, we're keen to hear more detail in terms of what interventions might be possible to support the smaller range of credit unions, and who, to be fair, have lots of innovation and aspirations to grow as well. So, we've had that conversation ongoing. I think from an ABCL perspective, in terms of tangible support items, we would be keen to, to continue to consult with our members, particularly in that range over the weeks and months ahead, just to figure out the ongoing impact in COVID and to see if there's something that we can do around embedding some of these methodologies and even start that journey. And that's not to say that some of them may not already have some really robust ways of dealing with scenario planning and business planning overall. I think for us it's a little bit of an information gathering exercise, and maybe just let's get an understanding of what's out there. Is there any best practice? How can we embed some of that, and then work in conjunction with yourselves for the duration of the rest of the year until such time that we've got more detail on the specific interventions. So I appreciate that. Thank you.
Brilliant, thank you, Robert. And I think there are also some questions in there in terms of consolidation and merger. I think probably the one thing that I'd say is that we recognise it's not a one size fits all, and that to get deep reach into certain communities, one does need some really focused local community finance providers. And equally, we know that lending is a scale business, and so balancing those challenges and thinking about how we can do that effectively, I don't think we've solved that yet within the sector. And I think some of the questions that have been asked in terms of can CUSOs work for small credit unions who've got a volunteer component, I think we don't know the answer to that yet. I think that's what we collectively need to work through together, with an open mind as to the possibilities as to how we can look at it. Now, what I'd like to do next is take us into just some of the questions around the data, and I'm going to take that over into Neil. And Neil, if you want Paul also to comment on that. If you just let Temi know so she can tee him up. So you have to multitask in terms of the messaging. But Neil, if you can pick up, I think that really some of the questions in terms of, the data and is it washing through as we thought, any particular insights in terms of smaller credit unions and what the data tells for us. So over to you.
Thanks. I probably will ask Paul to say something as well. Yeah, I mean, the data, as I said right at the beginning, is very varied. You got some, you took the month of September, we were seeing organisations reporting an increase in loan values, in some cases up to 50%, and others reporting a decrease in loan values. We will, of course, try and split out this data. There are only 44 in the survey, but we will try and split this out by sort of loan book size. We did that the last time round. People will remember there was a report which we called Fear and Loaning back in May, where we split out the respondents by loan book size, just to show some patterns coming through. Paul's a much more serious researcher than I am. He doesn't really like it when we get into that kind of detail, because he says there's not enough data to make kind of those type of pronouncements. But Paul, what do you think?
Yeah, thanks, Neil. Yeah, it is tricky to subdivide it. I mean, we haven't seen in the data, there's no suggestion that large providers have experienced sort of lower falls in lending. I think there's definitely fairly across the board. I think the issue is more around how to cope with it. So from the qualitative interviews, some of the smaller credit unions that are somewhere, or as the advisor are somewhere on the pathway towards sustainability, do have, are finding it more difficult to cope with the effects of COVID or effects of lower values of lending than some of the really large ones in our sample. There are examples of providers that are now going through sort of some of perhaps funding they perhaps initially thought about using for development that they're now actually using it to shore up. So I guess that's probably the only thing I'd like to add, really, Neil.
We will split some of this out, Sasha. We will. I mean, somebody asked when we would publish more of this. We will go and take a further cut at the data and try and split it out. I know people are keen that we do that. And try and kind of break down some of these thornier ones of, where loan values are down and loan volumes are down, but the loan income hasn't taken quite the same hit as yet. Paul tried to answer that in the Q&A. There may be reasons for that, about the length of loans that people are being issued. But we will have more to say on the data that we've got. And as Paul mentioned at the beginning, it is still open if other people are still able to. It doesn't take much to tweak some of this around a lot. You get a couple of big organisations in and it changes the data.
Brilliant. Thank you, Neil. Thank you very much for that. Now, what I want to move on to, I'm trying to answer some of the questions in the Q&A as well. So if we don't get to them all, we will pick up those questions and produce a sort of a written response to people so that you get all the value out of the session, because I'm conscious that we just have 1 minute to go. But what I am going to do is just turn to Tom, because I think there are some brilliant questions here in terms of support for mergers, different types of partnerships, things that we're working on. And I think that would be just really great to give just a slight overview on, if you don't mind.
Yeah, thanks, Sasha. I'll try and cover a number of them that I can see up there right now. There was probably one on just the general partnership approach, and then one on the merger support. So there's a question about local councils and whether they can be effective partners in this. We've seen some really excellent examples of deep collaborations between councils and community finance providers that have really sustained that provision, and we think it works really well where it's sustained it in a sustainable way, and it's also connected into the local ecosystem. So we'd probably really encourage those conversations, and we'd be up for helping with them if we can as well. I think it's from a council perspective, from what we've heard of, when it's clearly understood the way that affordable credit fits into an ecosystem of debt advice and other welfare support, that's when that partnership's been really effective. And then just to touch on the question of the merger support, so Fair4All Finance potentially has some resource to put into helping organisations who are looking to explore this. We've got a couple of projects going at the moment with specific organisations who are pursuing merger opportunities, and these can be in various forms. So the idea of merging into a CUSO and having that as a kind of first stage of a partnership is really interesting, and then a full merger it is also something that we've seen work in cases. This is something that we've put a bit of resource into elsewhere, so if it is something you're pursuing, then we can support that, and we'll probably publish something on what we've seen as best practice on this space at some point this year too.
Brilliant. Thank you, Tom. And I think that in terms of, I'm going to be cheat on people's time and sneak in one other question, which I think is just more in terms of the practicalities of how people have approached this rapid pivot to move online. I know that James has actually already provided a really comprehensive answer to that. So James, you've already provided an answer. So I think what I might do is just come to Faisal for any sort of final advice, just in terms of, how do you pivot when it feels like the world's all falling down around you?
That's a big question. I think the main thing I would say is where we managed to do this, where we have managed to do this well, or where we think it's well enough, is that we have reached out to get advice as much as possible. We are so conscious of the uniqueness of our service, we almost find it impossible to think about it in any other version other than delivered in a branch. And it took a lot of external advice from people who worked in similar or associated fields to help us navigate some of those questions about translating that personalized service into an online experience. So the one piece of advice I would give is talk widely, build your network, if necessary, get the right people on the board to help you with that conversation. But we were massively helped by talking to service design consultants, advisors who've worked on technology programs, people who've been involved in financial services in general, to help us think through how to make that change. And then realizing that the pivot is not temporary, it's a permanent pivot. And when you think about it like that, you start making some of the bigger real decisions that you have to do, which is what you're not going to do anymore. So I think those are my two advice moments: is talk to as many people as possible to get as much insight, and secondly, recognize that you're pivoting permanently. It's not a temporary shift.
Brilliant. Thank you so much, Faisal. And yeah, very mindful now of time, of having gone over. So I think that what I will do is draw things to a close. For any of you who have got particular questions around the technology side, we did do a Technology 101 webinar last week, which gave people, I think, a really good insight into the technology stack, and how you can make sure that what you do is very much sort of set in the context of the longer term vision of how you really get a digital ready business. So if you weren't able to join that, we do recommend a listen. There is a recording of that, and I think James, that's on our James Corcar, strategic comms person, that is on our website. We'll follow up in terms of the other questions. And I'd also encourage you, we've in our regular updates, we do them each quarter to give you a sense of where we're focusing at different points in time, because community finance is one part of our strategy, is not the whole of our strategy. And so it just gives you an idea of where we're focusing at each point in time. I think we continually wrestle as a team that we'd love to be able to do sort of 100 times more than we can. And also, I think we all know that unless you focus on doing a few things well, then actually you spread your resources too thin and don't make a difference on anything. So that is our sort of opportunity on our challenge. But if you do sign up for our updates, we can make sure that you've got some visibility of what's happening. And also each time we're working with an organisation, we are developing out tools and toolkits that we hope will become really useful for you and your boards as you navigate the future. And of course, this Navigating Uncertainty Guide is one of those. So I'd just like to thank everybody who joined us. A massive thank you to our panelists, and also to all of you who've provided insight and data into the surveys, because that I think is really important for you all to be able to understand where things are now. You'll get a follow-up email after this. It would be great if you can actually give feedback in terms of what you found helpful, what you'd like to know more of, and also just in terms of practical things on time of day and approach, anything you'd recommend that we do to improve. But other than that, I'll say thank you everybody for making time to join, and wish you all a relaxing and productive rest of your Wednesday. Thank you.